All right, let's jump right into this comprehensive explainer and completely demystify exactly how the government funds its massive operations. We hear terms like budgets, deficits, and revenues thrown around in the news literally every single day. But today, we're going to look under the hood and truly understand the machinery of government finance. We're going to systematically break down the government's cash register using a really straightforward five-step approach. We'll start by defining public revenue, then dive into the world of taxes, uncover non-tax revenue, weigh compulsory versus voluntary income, and finally, look at the center and state divide. So, step one, defining public revenue and making sure we understand the big picture here. Now, there's actually a massive difference between viewing a government loan as income versus looking purely at regular, recurring revenue. In the broad sense, public revenue includes absolutely everything, even market borrowings or selling government stakes in companies like Air India or LIC. Those are filed under capital receipts because they either create a liability, like a loan, or they reduce an asset. But in the narrow sense, which is kind of what we use for day-to-day fiscal analysis, public revenue only includes regular, recurring income that doesn't create debt. So think taxes, fees, and dividends. Moving on to part two, let's talk about the world of taxes, the absolute main engine of government income. So, a tax isn't just money you randomly hand over, right? It has very specific legal features. It is legally sanctioned, it's compulsory, and it's non-penal, meaning it's a civic duty, not a punishment. But a really crucial concept here is no direct quid pro quo. What does that actually mean? Well, it means you don't get a measurable, direct benefit in return for your specific payment. Paying a road tax doesn't mean the city is going to build a brand new road right outside your house just for you. Your payment goes into a massive general pool for nation building. And within that, there is this great divide in taxation, direct versus indirect. A direct tax, like your income tax or corporate tax, is paid directly by you to the government. You can't shift that burden. The actual financial pinch falls strictly on you. But an indirect tax, like GST or customs duty, is collected by intermediaries. The seller collects it, but you, the buyer, are the one paying it, so that burden can be shifted entirely to the final consumer. Let's weigh the pros and cons here, starting with direct taxes. On the plus side, direct taxes are highly progressive and fair. They promote equity because they're based on your actual ability to pay, which helps reduce wealth inequality. But, and it's a big but, directly targeting income has some major downsides. High rates can actually disincentivize hard work and savings, and unfortunately, they also open the door to a much higher chance of tax evasion. On the flip side, indirect taxes cast a much wider net. Because they're baked right into the price of goods and services, they're extremely difficult to evade and honestly pretty convenient to pay. Most of the time, you don't even realize you're paying them. However, that leads right into their demerits. Because consumers don't always realize they're paying a tax, it drops civic awareness. And worse, indirect taxes are inherently regressive. A low-income earner and a billionaire pay the exact same tax on a bar of soap, which obviously puts a significantly heavier burden on lower-income folks. All right, let's pivot to part three, uncovering non-tax revenue. These are essentially the hidden income streams. Here is an incredible, kind of insider secret listed under administrative revenue, seigniorage. The government literally generates income simply by printing money. Think about it. If a 500 rupee note only costs 3 rupees to print, that difference is considered seigniorage income. It's a powerful monetary tool that seriously contributes to the government's fiscal resources. And check this out. Here's another captivating concept called escheats. In rare cases, if an estate or piece of property is left completely ownerless, meaning absolutely no legal heir can be identified, it doesn't just sit there forever. It legally defaults straight into the government's pockets under succession laws. Just to put the massive real-world scale of non-tax revenue into perspective, 2.69 lakh crore rupees. That is the record dividend the Reserve Bank of India transferred to the center for the 2024-25 financial year alone. So non-tax revenue isn't just pocket change, guys. It is a vital multi-trillion rupee pillar of government finance. Now, you might be wondering, what's the actual difference between a tax and a fee? It's a common point of confusion. Well, a tax is compulsory, it's meant for general public expenditure, and offers no direct benefit. A fee, however, is a voluntary payment made to recover the cost of a specific service rendered directly to you. Think of a passport application fee or getting a driving license. You are paying for a direct, specific benefit. Which brings us to part 4. Compulsory versus voluntary income. Let's look at this from a behavioral perspective. So, we have compulsory revenues, like taxes and fines, which are strictly enforced by law. Then we have voluntary revenues, like gifts or grants, which depend entirely on goodwill. But it's fascinating how things like petrol prices sit right in the middle as partly compulsory. It's voluntary because, well, you can choose not to drive. But if you do use the service, the government uses its monopoly power to raise prices, making the payment absolutely compulsory once you're standing there at the pump. Finally, Part 5, the center and state divide. Let's talk about splitting the pie. The Constitution distinctly outlines who gets to tax what. The center handles matters with a nationwide scope, so they're collecting corporation tax on company profits, personal income tax, and customs duties on imports. On the other hand, states strictly govern local economic activities. They collect revenues from land, stamp duties on property transfers, road taxes on vehicles, and, crucially, state excise duties on the production and sale of alcohol. And honestly, states get incredibly creative with their non-tax revenues. Because their tax base is a bit more localized, they utilize everything from charging for police security at private events, to forestry and wildlife tourism, to collecting royalties on mining operations, and in some places, like Kerala, running state-operated lotteries is an absolute massive source of non-tax income. Now, to balance this whole federal structure out, the center actually transfers massive chunks of funds back down to the states. These are known as grants in aid, mostly based on Finance Commission recommendations, and they're highly specific. Revenue deficit grants to help struggling states, disaster response funds for natural calamities, and GST compensation to offset any revenue states lost when the unified GST system rolled out. So, we've seen how comprehensive public revenue really is. It's collected through direct and indirect taxes, through fees, fines, and even through printing currency and running lotteries. It's a massive, inescapable, and highly structured system. And after seeing just how deeply integrated this is into our daily lives, this is the ultimate question you need to ask yourself every single time you look at a receipt or a pay stub. If every purchase and paycheck you make funds the nation, are you demanding enough return on your civic investment? Keep that in mind. Thanks for joining me on this explainer.